the first SEC-approved crowd-funded real estate deal, the liquidity premium in REITs, and the non-linear growth of the industry. My guest today is the effervescent Ben Miller, co-founder and CEO of the online real estate crowdfunding marketplace Fundrise. Welcome to the National Real Estate Forum podcast, episode 204. Thank you for joining me today. I am Dr. Adam Gower, and this is the Crowdfund project at nreforum.org, where developers, investors, and industry leaders share insights that you can use to raise capital and invest in crowd-funded real estate deals. One concept that comes up in today's episode that fascinates me is this idea of the liquidity premium when buying into a REIT. How much of a premium are you paying when you buy real estate in a REIT if the real estate itself is illiquid, but the share that you bought is completely liquid? In a future episode with Greg McKinnon of the Pension Real Estate Association, I drill down on this idea. But once you have heard Ben Miller talk about it today, I would love to hear your thoughts on the idea and on anything else that he discusses. Please go to the comment section of the episode at the bottom of the show notes that you can find at nreforum.org/fundrise and let me know what you think. If you want to become an expert in raising money and investing in real estate deals through crowdfunding, you are absolutely in the right place here at the nationalrealestateforum.org. I have put together a summary of what crowdfunding real estate means to you, whether you are a developer looking for money for your project, an investor wanting to find deals to invest in. Just go to nreforum.org/primer and I will send you a free high-level summary of the key features of crowdfunding real estate and how you can raise capital and invest in deals. Ben Miller is co-founder and CEO of Fundrise. His responsibilities at the company involve developing strategic partnerships, deal underwriting, real estate development, and setting the long-term goals for the company. He talks about all these aspects today, and I have little doubt you will find his enthusiasm and insights just as compelling as do I.
Yeah, so I started out at the beginning of my career, which now is starting to get a little longer ago than it used to be.
And then you'd like to remember, right?
Well, I mean, it's funny because, people expect tech entrepreneurs to be like 22 years old, and I'm like definitely old, and I'm like definitely
not.
Not. So I'm not like old yet, but I'm definitely not young. So anyways, but maybe I'm fooling myself. I think actually my head of marketing is like, no, Ben, you are.
Right.
So so I started out working in a private equity fund years ago.
Okay.
And it didn't suit me. I found it to be just too removed from the real estate. And made my way to become I started working for a real estate development company and ended up becoming president of that real estate development company that did urban retail, kind of mixed use real estate development in Washington D.C.
Okay.
And we would do big projects, so talking about like $100 million, $200 million real estate development deals. So these were for Washington D.C.
And so when was that? I do want to date you a little bit. When was that?
Okay.
What period of that? Yeah.
Okay. So I started my career in 1999.
Okay. All right.
And so most of my real estate development hands-on experience starting in like 03, 04.
Okay.
Up till Fundrise, which we started in 2012. So
you lived through a big downturn.
Yeah, well, I lived through two. I lived through 01.
Okay. The dot-com down, right?
Dot-com. Well, it's funny. I was looking at some stats recently. So in the 2008 collapse, America lost 8 million jobs. Mm-hmm. And in 2001, it lost 5 million.
Interesting.
Yeah, which you wouldn't have thought that it was that's almost comparable. So it's interesting how much worse that 2008 was, but But anyways, yeah, I've been through 2 recessions, and so I'm scarred and maybe twice bitten here, so I'm a little shyer than I used to be. But
right.
So yeah, but really when it comes down to the experience and why we started Fundrise, it was being a real estate sponsor, being a real estate operator, raising money from in that case we raised money from private equity funds, or we had some insurance fund partners, so they were big capital partners, and then in 2008 one of my big financial partners, we're talking about I think a $250 billion in assets fund, went bankrupt. That was GMAC Commercial, which got bought by Goldman KKR and 5 Mile, and then levered up. Goldman KKR and 5 Mile, and then levered up, and then blew up. And they held a lot of derivatives, CDOs and stuff. Part of the reason you think that they trouble. But the point is, I came out of the 2008 recession feeling like, well, there's got to be a better way. This way has some issues, and that's that's where I feel like essentially my experience is what informed the idea of creating this concept of online fundraising for real estate.
So now this emanated from the Jobs Act, didn't it? Which was, when was that? That was 13. So you were right at the cutting edge of that. What was it that gave you a sense that this was the right path to take? I mean, no one had trodden it before.
Yeah, so funny enough, my work predates the Jobs Act by 2 years.
Okay.
So we conceived of this idea September 2010, and with this idea of raising money on the internet for equity. So this was pre-Jobs Act, pre any of this stuff. It wasn't even called crowdfunding.
And how were they responding then at that time? What was their response? I mean, they must have been working on it and thinking about it, right?
No, they were not. I mean, nobody was. They definitely were not thinking about it. This was. I ended up by happenstance finding a friend who introduced me to the former head of the Corp Fin Division, former General Counsel at SEC, and he took his normal clients were like JP Morgan, so he took us on as like a fun project, and we convinced the SEC to let us do it. So we did this.
Pre-Jobs Act.
Pre-Jobs Act, and it may be a coincidence, but I don't believe it was, that our work with the SEC, doing it, raising money for a real estate deal at $100 a share, I think it informed the SEC, at least, and some other people sort of generally, that it informed the SEC, at least, and some other people sort of generally, that it worked. It was it made sense. Basically, once you saw it in action, you're like, oh, this makes sense. I see why this should be allowed. It took us a year. Basically, we went to SEC. We want to do this, and you can have the General Counsel of SEC as your lawyer. He knows a lot about how to do these things. So he said, well, there's a regulation no one's really used since 1995 that I think we could use to allow this, and it's called Regulation A. Yeah, and it was before they reformed Regulation A, and we went to them. Right. We do an internet, and there were a lot of things you had to. Now these things we take for granted, like how does somebody buy a security online? What do they fill out? What does the staff expect? The staff being SEC staff, which we just call the staff. What do they expect? What kind of like language? And so we created all these things, and I know, because I know a lot of the founders of a lot of the other companies. I saw them sign up for our site, and so it's gone in places we never imagined, and it's grown in ways we couldn't have fathomed. But it was we were kind of a painful, slow. I mean, we did one deal in 2 years, working with the SEC, and we had to buy the real estate deal. We did 11 Form 1A is what we ended up using. We actually now use Form S11, even though we file under Regulation A+. So there was just this, and the properties we crowdfunded and we opened, they're literally 5-6 blocks from the SEC's headquarters. Okay. So they were really intimately familiar with this concept, and I think a lot of their they really went. The Jobs Act passed, but the promulgation of the law, which is what the SEC
right
take years to write the rules specifically. They really went above and beyond in places, way beyond what the Congress had imagined when they thought about how it should work. And I think that's because they saw it working in a few places, and helped it illustrate for them or like flesh out the reality of this concept.
So was it like an IPO in a way? It was a public offering that you did online for real estate?
Yeah,
Is that basically what an IPO in a way? It was a public offering that you did online for real estate?
Yeah,
is that basically what you did?
Essentially, we did that. We raised $325,000, $100 a share. It took us a year and a half or something to put all the things together, at least. So, and there were many, many times when like we were just, we hit a wall. But we were, I wasn't doing it initially because I needed the money to buy the deal. That obviously wouldn't have worked logistically. So
right.
We could be sort of more relentless, more sort of persistent with it because we were able to basically like make doing that the business.
Right, you were creating a business, right? I mean, you did say 320,000, didn't you? You didn't say 320 million. It wasn't a lot of money, right, that you were raising.
No, but it still took. I mean, that's true. But I mean, we probably spent and we ate hundreds of grants just to do it.
Right. You were creating a business. So now, out of that, is that how Fundrise emerged?
Yeah. So that's where we came from. We were a real estate company. We owned real estate and we developed real estate, and we were doing it for the real estate. And after we did it 2 or 3 times, we decided, well, this is. I mean, we always sort of hoped that it could become its own business, but it was very. It wasn't. We did 3 deals in 3 years or something, right? It was just very, very intensive and slow at the beginning, but eventually we were able to spin it off and scale it up, and it became Fundrise. And we were the first quote real estate crowdfunding, and in a way I don't want to say we birthed an industry because I think it was coming anyways. We were just the first to do it, but we helped I think create some of the platforms for this new space.
Well, that's right. I mean, it is a completely new space now, isn't it, as a result of the Jobs Act?
Yeah, the Jobs Act is what allowed us to scale. Before, if they hadn't changed the regulations, we couldn't have done it. I mean, we were doing 1 deal a year, right? I mean, now we do a real estate, we probably close a real estate deal a week. And so the scaling became possible because Congress and the SEC and President, everybody basically said, well, this is an opportunity to innovate. And they did.
So let me ask you something. I understood that the Jobs Act was oriented primarily to tech companies, and that the benefits that have accrued to the real estate industry were almost accidental. Would you characterize it that way, or do you think that real estate was, in part, because of your activities, a driving force also to the Jobs Act?
No, I think you're right. I mean, I remember I was on the Hill kind of past Jobs Act. I would be in a room with like somebody from WeFunder or Indiegogo. Right. And I remember being in a room, and one guy looked at me from like some web, and they're like, "What are you, real estate? Well, that doesn't make any sense. This is meant to be tech."
Right, exactly.
And I was like,
that's right.
I'd rather own real estate.
Very nice. All right, yeah, so that's actually that. It is kind of accidental, right, that it's benefited real estate. Okay, so you've described a very deep background, all right, pre-Jobs Act, crowdfunding real estate. Let's talk a bit about where the industry is today and where you think it might go in the future, how influential on the world of real estate you think it might become.
So for real estate, not for all.
Yeah, real estate. Yeah, just real estate. Yeah.
Be increasingly influential. It kind of reminds me of just writing this blog post about e-commerce in 1999.
Okay.
I remember, because I was actually working in real estate and I was also a little bit in tech back then, and everybody thought it was going to change the world. And then it blew up, and everybody thought it was overblown, and it was basically like not going to do anything. And that's, I think, crowdfunding. Basically, at the beginning it came out, people thought it was going to change the world, and then basically now, I think we've gotten to a place where people are saying, well, maybe it's not going to have that big influence. In fact, Blackstone and big insurance companies are way bigger than this will ever be, and it's sort of not that relevant. And that's why I think basically what people thought about e-commerce in 2001 when the bubble burst and people said, well, Amazon, it can't have that big an impact. And their shares, remember, their shares were down 94% from peak in 2006. They went from $100 a share to $7 a share, something, or $6 a share, whatever, $5, whatever the number, 90-some%. And what I've experienced, and I think is indicative of how people think, is people don't understand nonlinear compounding.
Okay.
And
explain that.
So, our brains are built by living in tribes in the wilds, for hundreds of thousands of years, and the brain is built to deal with a spear being thrown at you across the field, a rock being thrown at you. It's all of those calculations are linear, and your brain needs to be able to know how to calculate a linear equation, because if it can, it's going to basically be, you probably would have been killed by that falling spear. You got to move out of the way. But lots of things, especially in the modern era where you have technology in particular, are nonlinear. And so a nonlinear equation, an example of a linear equation would be accelerating acceleration.
Okay.
Right.
Feet per second, right?
Yeah, you're going faster. Your rate of acceleration is increasing.
Okay.
Right? Like when you throw a spear, it doesn't get faster.
Right.
As
it slows down.
Through the air.
Yeah.
It slows down. So if you got faster, what would probably happen is you wouldn't move out of the way in time because your brain is not designed to recognize
to accommodate that, right?
That goes faster as it travels through space. It goes
Interesting.
slower.
Okay. All right.
And so that's the nature of certainly a lot of technology, and so the curve is it's a if you look at the growth curve, it's a curve, right? It's not a flat linear curve, and so we always underestimate it as a result. We underestimate the growth rates because we aren't designed to think in nonlinear growth rates, nonlinear ways to think. So that's what I think. It's a long way of saying think that the growth in crowdfunding will surprise everybody. It will be a lot bigger than people expect. And then it'll end up merging. I think that in 20 years, let's go far out, all fundraising, all investing will be, in a way, a form of crowdfunding because everything will be internet-based. The idea of a non-internet-based transaction will be like a quaint idea.
Now you're doing some interesting aggregation, aren't you? You're offering investors not just an opportunity to invest in individual deals, but you're also aggregating deals and offering different return profiles and different risk profiles.
Yeah, we ended up moving over time. We've evolved. We started out in doing a real estate crowdfunding deal for equity. We moved to doing only debt because I concluded that equity was not resilient to sort of the nature of essentially to these sort of like mini pools. And so essentially it looks a little bit like a fund.
Right.
But the difference between, let's say, like what we're doing, what you normally see out there, normally if an individual is investing in real estate, they're buying a share of a public REIT, which is really a piece of paper that's a secondary trade. And that's basically liquid because the market for it is deep. So what you're not buying at some point, the derivative that is a public REIT is so separate, so different from the real estate itself, it doesn't act like the same asset. In particular, you're usually buying it at a huge premium to the actual asset. So when you buy public companies REIT or even Vanguard REIT index, that investment is very different than owning the property, in particular the basis you're paying. So it's easy to explain why, but I think it's at least a 20 to 30% premium.
Okay, so then why is it? I think you're talking about layers of fees, but surely fees can't be 20, 30% on top of the value.
I think it's even more, 50, 100%, but it's at least 20, 30. I mean, the three simple reasons is one, in a public context, you are getting daily liquidity. Right? It's a liquid asset.
Okay.
I can guarantee you that liquidity is not free. Right? The building you own is not liquid. There's no way people pay the same price for a building that's illiquid and a piece of paper that's liquid. So, and we just think about it intuitively. How much more would you pay for something that was totally liquid? A lot more than 1%, right? A lot more. And so It's what's interesting about this idea of this liquidity premium, which is it's such a natural assumption people no longer see it. Is clearly it's valuable, clearly it's expensive. I'm just going to use a rule to say this, and then we can talk about it right now. I'll say it's 20% minimum. I'm just going to use a rule to say this, and then we can talk about it right now. I'll say it's 20% minimum, because you would say, how much more would you pay for a building that's liquid? You'd say 20% for sure, right? Because you're talking about not just liquid. The transaction cost on that piece of paper is almost zero, right? The cost to sell a building is much higher than the cost to sell a piece of paper that's a derivative of the building.
Okay.
So there's a lot of reasons why it's 20-30% or more, but it's significant. So the question I ask you is, if you are going to buy something and hold it in retirement or for 5-7 years, if you're a buy and hold investor, why are you paying a liquidity premium?
Right, you don't need it, right?
You don't need it, but you're paying for it.
I see.
And I think that's a huge invisible cost to the individual investor that really makes no sense to me.
Okay, so now how is your platform different from that? You don't have liquidity, and therefore,
if you put $1, let's say you put $1 onto our platform, that dollar goes directly into buying that property. We buy it, we fundraise, and we close on real estate on a continuous basis. So it's happening very close into real time. It could be days apart, weeks apart, but it's very, very contemporaneous. And so you're getting at the real asset, which pretty much is impossible for an individual unless they bought the property themselves.
If you would like to see a summary of my conversation with Ben, as well as a downloadable transcript, please go to the nationalrealestateforum.org website, nreforum.org/fundrise, for the show notes to today's episode.
okay, so now as people invest through your platform, are they identifying what assets they're going into? Or are they looking at pools, investment characteristics that appeal to them for risk reasons or hold period reasons or whatever it happens to be?
Yes. So we've evolved over time. We've concluded that the best way to give people buckets or like categories is to build it around what they're looking for, their goals. So it might be they're looking for high income, or they're looking for long-term growth, or they're looking for a certain strategy, low risk. So we build it more around the results, because how generally I'd say 99% of the population, they don't know about, should you be doing mezzanine investment in this apartment deal? Should you be doing JV equity? Should you be doing a whole loan? Should you be doing 100% of the stack? What is the right way to do it in this deal, in this geography, with this real estate operating partner? That just doesn't make sense to be asking individuals to make those decisions. That's so you want to give them the. It just doesn't make sense to be asking individuals to make those decisions. That's so you want to give them the consequences of those decisions and let them navigate based on the goals they want, not based on the sort of the work we have to do.
Right. So somebody comes, they have a low risk tolerance and they want a long-term income stream, let's say. So they invest in one of your funds, and then those investors, their funds are aggregated, and you now move into the market and start identifying deals or parts of deals that accommodate their particular profile in which to invest. Is that right?
On a real-time basis, yeah. It's one of the reasons that's possible and was impossible before is that, if you think about before, roll back the tape 10 years, which is pre-crisis, and then or even roll back the tape 30 years because it hasn't changed. And if you wanted to do that before, you had to go have coffee and raise the money. You'd go, on a road show and meet tons of institutional investors, or you'd go to country clubs. The normal private equity fund, just as an example, it takes them on average 15 months to raise a fund.
Right, and they will raise that from institutional investors as well as high net worth individuals, right? Yeah.
Generally, it's institutional, and so there's a very long lead time to raise it, and then on average, a fund life is 3 years to deploy it. So you're talking about four and a half years, for the life cycle of an investment. And we have, and I was telling you, we do it in days.
Yeah, it's incredible. See, what I was getting at with that, Ben, was this idea that if you do look to the future, it's almost as though as you build to scale, you are beginning to act as those institutional investors, those private equity. You're much more efficient because you're doing it online with tens of thousands of investors rather than over, lunch and golf, perhaps.
That's our view. I mean, that's our opinion. I like to say it's fact, but until the that all the chips fall, it has to be proven. But we have more technology that drives greater efficiency, and then there's a cultural difference. Generally, the financial industry maintains margins. There's not a culture of competing to lower fees among financial industries. So if you, for example, you look at investment banking, the underwriters charge typically 6 to 7%. 7% is kind of the norm, unless you're Facebook and you're raising whatever $20 billion. And Morgan Stanley, Goldman Sachs will compete for that business, and neither one of them is going to undercut their fee. They'll sell you on other benefits and for decades, and that's not the culture of tech. Amazon relentlessly cuts costs to drive scale. And you don't see that in real estate private equity. Private equity, their fees came down a little bit after 2008 from 2%, 2 and 20 to maybe 1.5 and 20.
Yeah, exactly. Management fees, right?
Management fees, yeah. So I think that there's and what I'm sort of partly agent to, which is to drive this change into real estate, is happening in every industry. It's maybe why inflation is remaining low, is that there's just this relentless technology-driven cultural change.
Well, competition that never existed before, right? It's kind of newcomer.
Yeah.
That's not competing with different rules.
Yeah, maybe that ultimately it's competition, but it's because we're coming from outside the system.
Right.
We're not playing by the rules that you don't cut your costs. And actually, the interesting thing about why funds cut their fees to raise money. Well, because the institutional investors don't find that attractive. Generally, the institutional investor, you go to them with lower fees, they think, well, this must not be as valuable. They don't get fired for investing with somebody with high fees. They get fired for investing with somebody who is new.
Who fails. Yes, exactly. Right, exactly. The CYA investment. The CYA investment.
Yeah.
Right.
Yeah, you can fail as long as you fail with Carlyle or Blackstone.
With somebody who is
Carlyle.
reputable.
Yeah.
Exactly. Right.
So it's because we come from outside the system that we have different, we have other rules we have to follow, right? We're heavily regulated, but we don't have to follow the same cultural rules that exist in the institutional private equity space.
Now, did you say that you don't do equity investments anymore? Or you just do debt?
We brought that back. We stopped for a while that equity investments do not make sense unless you're in a pooled vehicle.
Okay.
Having been, I think this is a fact. To do an equity deal as crowdfunding, I think is just as a simple one-off. Here's a single deal. Here's an office building. Let's crowdfund it. I think that's a disaster waiting to happen.
Oh, on a one-off deal.
On a one-off deal, yeah. I think it's because every real estate deal I've ever done, and I've done a decent number as JV partner, always needs more capital.
Right.
Always
under budget and takes longer than it takes, right?
Yeah, it always takes more time. Right. It's over budget.
And the investors have to come up with something else. Right, it's very complicated.
There's lots of. I've on the crowdfunded deals where I was the JV equity and I was the equity and I crowdfunded it. I put in 0% loans personally, just to cover the $100,000, $200,000, 0% loans personally, just to cover the $100,000, $200,000.
Right.
These are little deals too.
But so how is that? But why is that any different? You're still investing in developers, right, and builders. They're going to make the same mistakes. Why is it any different on a portfolio or aggregated deal than it is on an individual one?
But once you pool it, then there's more sources of capital. There's more diversification in the cash flow streams. There's more ways that you can borrow against it. There's just a lot more ways to. It's like every REIT is a pool, right? And so, and it's much easier to hold cash across a few assets and the whole cash of one asset. So there's just a lot more ways to provide resilience to the inevitable ups and downs, inevitable problems in real estate.
When you do the equity pieces as well, are you taking a piece of the back end? Is that part of the property formula that has the waterfall and the splits, etc.? You're structuring the deals in the same way.
We don't. Our model is today we take a 0.85% asset management fee. So that instead of 2%, like a private equity fund, or 1.5%, we take 0.85.
Okay.
And then we do take an origination fee of 1 to 2% on the close. That gets amortized over sort of a normal life of a deal. Let's just say it's 5 years. It's like 40 bips. So let's say we're all in 125 bips, 1.25%, 125 bips, 1.25% a year. That's our flat fee. We don't take a carried interest. So our joint venture partners who are the developers, they usually do. That's the norm. That's how you get a good deal. We don't, and I felt like we shouldn't.
Why? Because of conflict? You think it's conflicts then?
Yeah. Well, this is my opinion, and this is kind of maybe philosophical, and then we can talk about where this may not apply.
Okay.
But when I look at most private equity funds I dealt with, they get 20% of the profits over an 8 to 10% hurdle. Usually 10. Right. It's come down to 8 over the last few years, but it's usually 8, let's say 8 to 10. Mm-hmm. Well, to get that, you need to be doing real estate deals that have 15 to 20%, maybe 16, 17% to 20% internal rate of return. To get a 17 to 20% return on a real estate deal is pretty difficult. You have to go really fast to take on a lot more value add risk. Mm-hmm. And I believe that the natural rate of return on real estate is not, even value add or opportunistic real estate is not naturally that high. It's exceptionally that high, but it's not naturally that high. It naturally is 12, something like that. And so the second you create this incentive to get 20% of the profits over a hurdle, where 12 isn't going to do anything for you, because that's net of fees, right? 12 on a 220 business is 10 net, right? So you have to take on a lot more risk. Yeah, that's your prep. So basically, to go from a 12% return, which I say is a really good organic return, to 17, it's not 50% more risk. It's 300% more risk. It's geometrically higher risk to get that additional 5% return.
Okay. So how does that feature inside your allowing developers to capture all of the profits and just burdening them with lower promotes or no promotes? I mean, how are you doing it then? Are your investors, if I invest in your fund, am I just looking at a steady return so that the developer's less pressured to deliver crazy high returns unrealistically, perhaps? Not quite sure where this links up.
There's two different players in this equation. One is the fund and one's the operator. So the funds, I'm saying when the fund has a 20% carried interest, many times it incentivizes them to take on more risk than they should to get higher returns. And by not having that, by basically passing that through to the investor, it changes the kind of risk profile that we seek out.
Got it. So you're passing it straight through to the investor. That's the key.
Correct.
Right? You're just not capturing anything in the middle. Interesting.
Right.
Oh, that's a really interesting model. But the developer is still paying it.
The developer still captures that. That's the industry norm. And as a result, you have to be aware that they have funny incentives. The developers, I like to say, the developer is like a car with only an accelerator.
Exactly. They'll keep on going as long as there's fuel, right?
Because they have such an asymmetric reward system, incentive system. Yeah. You have to recognize that even the best of developers just will behave in ways that they really shouldn't, except for the incentives. And that's why the system blows up. It's just, let me just do the math because the math's so compelling. When I was a sponsor, we did a $100 million real estate deal in 2006. We borrowed $80 million. We got a 90-10 partner, private equity fund partner, who put up 90% of 90% of 20 million would be 18 million. And we put up $2 million. We put up $2 million. We had a 50% share of the profits. over, I think it was a 9. So I got 50% of the profits on a $100 million deal.
That's a pretty good deal you had there. Yeah, nice, right?
That is and I would say that is like close to the norm
right.
of opportunistic real estate structures.
Right.
Maybe promote would be, but these days promotes are more like 30 over a 9 and
well, the 50%
over,
sounds very generous.
It was generous. It was 06, 07, so we got a lot of the upside. So, but I mean, if you're talking about it, for 2% of the deal, we have 50% of the profits.
Mm-hmm.
That's going to create, if you think about it, for an industry, you know, different incentives than for the investor.
So how do you mitigate that then with the funds that you have in Fundrise? What would that deal look like if that was going through your system now? How would it be different?
Yeah, so, well, I mean, that's more operating. This is not technology solution. This is more about how you manage the real estate company. One is half the deals we do are debt, so we don't have that dynamic. Nope. I mean, we're lender to those people. It's a little different.
You're part of the 80, right?
Yeah, we're part of the 80, and we charge a little higher interest rate because banks are a little more conservative these days. But basically, the short answer is that I wouldn't have done that deal. I wouldn't do that deal in Fundrise. It doesn't fit our profile because it's a high risk, high return deal. That structure is, at least that was a ground up urban infill value. It was a really complex, high risk deal.
Very high risk.
We do that deal. We'll do that structure on a stabilized workforce housing, boring building, and that you're buying at half replacement cost, where you say, okay, what's my risk here? So the way to solve that problem is the kind of deals you do, the kind of partners you have, and then also to recognize that you have to actively manage the sponsor, the operating partner's behavior. Mm-hmm. I used to think you didn't, when I started the Fundrise and I was a sponsor, I used to think, well, you don't need the fund manager because they're just a middleman. And now I realize, well, the developer needs somebody to keep them from going off the cliff. They're I mean, this is going to be a little bit strong language, but oftentimes they're predatory because the developer will raise money 2-3 times a year, so they have like a free rider problem, right? They have a problem to take advantage of the investor for that one deal, because if they can make $20 million in one deal, they don't care if they screw all the investors for the next deal. So the fund acts as it creates like an enforcer mechanism that's systemic. It doesn't exist. I'm not getting. Maybe I'm getting too complicated here. I just.
Yeah, no. I get
it.
Not in the slightest. No. So are investors investing in you, and you're investing in these deals, or are they going direct? In other words, where's the fiduciary responsibility? Because that's what you're describing, right? Why are you're managing the developers in the same way as a private equity fund would? Mm-hmm. Mm-hmm. Is that because
For sure. They're investing in us.
Okay.
Our job is to run, either to be the lender and to foreclose on the deal if necessary, or to be the joint venture partner who has to basically select a deal, which we'll look at dozens of deals before we close on one. Many, and then you have to just manage the deal constantly.
Right.
So yeah, I came to the conclusion that you need to have this role of providing selection, that you need to have this role of providing selection, management. I mean, we're really actively involved in, much more so than you might imagine. I mean, we have a real estate deal where, an apartment building, and we're looking at we'll help manage.
This with the plumber.
Yeah, well, in this instance, it's about the leasing, but it's because interestingly enough, a lot of apartment leasing is actually done online, and I know a lot about that.
Right.
A lot more than most real estate folks. So
yes, indeed.
Anyways,
it's very interesting because if it weren't for the way you raise your capital, you sound very much like a private equity fund, right? Like a traditional.
That's my point of view. That's my point of view. That's not. There are other people and a lot of venture capitalists who I met with who disagree with.
They see you as a tech company.
Well, they see it as a marketplace. Our job is basically to to be a marketplace where investors and developers come together, and we maintain a minimum level of quality, where our job is not to pick winners and losers. Our job is to maintain, minimum quality standards.
Okay.
And that's a very tech mentality. That's sort of like how you'd think of like Craigslist or eBay or something. And I think that's crazy. But they think they don't like the idea of having to know about real estate. They don't know anything about real estate, so that's to say that you have to understand the substance of the business is not how venture capital
anathema generates.
Right. Yeah, that's not how they work.
Yeah,
they
it's
want to say that they say they're good at pattern recognition. That's what they say. They're good at pattern recognition, so we don't have to know about the substance of the industry because we know about
interesting confluence of two industries, right? You've got this old, staid, extremely traditional industry of real estate meeting the tech industry, which is the exact opposite almost in terms of the way it sees the world. So you have to be an expert in both, right? You have to translate those two worlds to be effective.
Yeah, I get the question: are you a real estate company or a tech company? I say you have to be both. You have to have a spliced DNA. You can't be one or the other. You have to be the best of both, basically. And that's our point of view. The story's not over yet. There's other people who think that it's about a different approach, and only time will tell.
But let me ask you, what's going to happen, do you think, to the industry during the next downturn? Right? You've seen one. You've seen a really big one. What do you think is going to happen when we see the cycle come full circle to the crowdfunding real estate industry as it's going to look different on the other side?
Yeah, well, I think most will blow up. Unfortunately. I mean, and I worry about it every day. It's like doing deals that are designed to weather a recession, and then sort of coming out of that, there'll be a period during the recession where everybody makes a categorically this didn't work, and then I think that a few companies will emerge from it proving that it did. And honestly, by that point, we're probably 10 years old, and we probably have $1 billion of equity and $3 billion of real estate or more, $2 billion of equity. And I said 10 years old and billions of equity, we're basically institutional. We're an institutional model and that's when it gets really interesting.
I cannot help but agree with Ben that the next real estate downturn is going to see a lot of pain across the real estate crowdfunding landscape. Only hearing that echoes Ben's comments is that not only are deals likely to struggle, of course they will, that's what a downturn is, but that platforms that do not themselves have resilient economic models are also going to falter. What will that mean to you if you invested in a deal through a platform whose website just shut down for lack of funding or other reasons? Find out and stay ahead of the crowd here at the National Real Estate Forum, where you can learn more about the space than you can anywhere else online. If you would like to know more about how you can raise capital and invest in crowd-funded real estate, please download a copy of the PDF primer that I've put together and that you can find at nreforum.org/primer. In the next episode here at the forum, I speak with Lisa Canning, who is the Education Czar at Crowdfund Capital Advisors. CCA has a definitively global view of crowdfunding, was an early contributor to authorship of the Jobs Act, and is evangelizing crowd-funded capital raising internationally. I have installed links on the website at nreforum.org so that you can subscribe on whichever podcast platform you use. Just go to the website nreforum.org and click on any one of those links to subscribe to the series so that you're sure not to miss an episode, and so that you can become an expert in this transformational new way to finance and invest in real estate. Thanks so much for tuning in again, and thank you also to Ben Miller of Fundrise for sharing your time with me today. Until next time, this is Dr. Adam Gower signing off.